Most investors look at GPIX and see one thing: income. But income alone doesn't tell you what actually happens to your money over time. So instead of debating yield, strategy, or marketing language, I ran a full backtest. What happens in a flat market? What happens during volatility? What happens when growth outpaces income? Because the real question isn't what does GPIX pay, it's what does GPIX actually do to your portfolio. Today we're looking at real performance, not theory, not projections, not hype. So stay tuned. Welcome back to Simply Money. If you're considering GPIX for income or comparing it to growth-focused ETFs, this breakdown will show you exactly how it behaves over time and whether the trade-off is worth it. So let's dive in. We have our spreadsheet here for those that are new to the channel. Thank you for joining us on Simply Money. What we do on these series of all-in scenarios is we take a particular fund. Today we're looking at GPIX, and we say, what would happen if I had taken my full income portfolio, invested it into this one fund back at inception, and then we just did these different scenarios of full drip, 50% drip, or no drip, and how would it have performed over this time frame? Now, we used the $525,000 because we started the series from a request a viewer had asked me to do on one fund, and it just began to go from there. I know a lot of people will say, I don't have $500,000. That's fine. This sheet you can use. You can get a copy of it on Buy Me a Coffee down below in the link in the description. You can change the date that you started when you invested. You can change here in this yellow J1 how much you actually invested. So maybe you had $10,000 or $5,000 or $50,000. You can put that here, and all this will populate for you. Then over here, we have some calculators. We'll look at that in a minute. For our subscribers who are back, thank you for joining us again. I appreciate your support. You guys make this all worth it. I appreciate all your comments and feedback. Some of the best suggestions come from your comments. Keep them coming. And don't forget to dialogue and share with one another, and keep it cordial. We're here to help one another, encourage one another. If you disagree with somebody and their investing style, it's okay to share that, but you don't have to name call or, I get some of these comments like, oh, you're an idiot for doing this. That's fine. If you think somebody's an idiot, I think a lot of people are idiots, but I don't have to tell them they're idiots. In fact, they probably already know they are. Anyways, that's another day, another video. Today, we're talking about GPIX and what has it done. December 4th, 2023 is when we're starting this. The starting price was $42.59. This is a monthly paying fund, so it pays once a month. And the ticker symbol here, GPIX. With our $525,000 hypothetical portfolio, we got 12,327 shares right here. And so we'll follow along with that. We're going to look down each month. We'll see how the share price is done. We'll see how much the distribution was, and then the different drip scenarios, and then what our portfolio balance versus our income and all those wonderful things that these sheets show us. Now, with that being said, remember, this is not financial advice. This is for informational and educational purposes only. Please do your own due diligence and know all investments come with risk. Okay, column B, share price. The stock price of GPIX started at $42.59. We're just going to slide down here a little bit. You can see that it trended up slightly into 2024, got up to $50.59, and it dropped back down here. Guess what this was? April of 2025, got down to $42. That's right, Liberation Day, the tariff, all that went on, all the market dropped in panic, and that's a good note. I like using these scenarios like COVID and the Liberation Day. News cycles can create fear in the stock market. People get scared, they start pulling their money out. That is the best time to buy. When fear is rampant, that is the time to buy. When everybody's greedy and everyone's like, oh, you got to get into this new stock, this new thing that's out there. It's booming, it's taken off. By the time you hear about it, by the time I hear about it, that it's taking off, it's probably already hitting its peak or well along the way, and you're buying it at a premium. I like it when things are going down and everyone's like, oh, you got to get out. The stock market's crashing. This is no good. And buy it at a discount and then watch it rebound. What happened right after this $42? Well, by August, it got back up to the $50. And then it went even higher. And we're ending here at $57. As of February 4th, 2026, it's up at $57.68, which is a 35.43% share price increase just in this time frame. This is just over 2 years, and we're looking at that and seeing that it's gone up 35% just in share price. And this is an income-focused ETF. And so a lot of times when you see an income-focused ETF, you'll see the share price flat or dropping. Now, I know this is a short time frame. For a lot of people, they think, oh, that's great. I always want to caution you. 2 years is a very short time frame in investing. You should be looking at 5 and 10 years if possible. These funds don't have that time frame. So we look at what we have and we make judgments based on that. One of the things I want to point out is that when the market goes down, and this follows, and most funds will, but when it recovers, does this recover? Does a fund recover when the market recovers or its underlying funds recover? And this one did. Yes, with covered calls, you are capping some of your upside, but does it gain a lot of it because it mitigates some of the downside? Is it gaining a lot of the upside? Some funds mitigate the downside but lose almost all, if not all, of the upside. This fund seems so far to be following that trend where it mitigated the downside. You still had a loss. It still dropped, but not as far. And it recovered, but not as far. So it's a nice blend of both. A 35.43% return on share price. Now we have to look at the income. What is the distribution or the dividend that it's paying each month? Well, we can see here it started at 31 cents. As we scan down here, you're seeing it's in the low 30 cents. It goes into the mid 30s. Now it got down here right after Liberation Day, got back down to 32 cents. So it didn't drop drastically. It just dropped a little bit. Correlation to the share price. Your yield stays about the same. As the price drops, the share amount drops, but the yield stays the same. I'm just saying 10% for the sake of easy numbers. 10% is 10%. Whether you're getting 10% off of $40 or 10% off of $50. So the 10%, the yield is what's happening. And so you'll see your distribution dropping slightly. But as the share price recovered, you see that the distribution recovered, and we're ending here up in the upper 30s, 37 cents for the last 3 months. On average, over this course of this time, it's averaged 34 cents. It's been a nice, steady, consistent distribution with a slight increase overall. Doesn't mean there's not some ups and downs, but the trajectory is up. It is trending upward, which is a good thing. All right, let's go over here. This column here is your full drip. That means you get your distribution. This amount will start here on January 4th, 2024. You get the 31 cents, and it's paying that on 12,327 shares, which is $3,858. On a full drip, what that means is we are dividend reinvestment plan. We're taking the dividend and we're reinvesting it. We're buying more of the same shares, and we're doing 100%, the entire amount. So this amount here, $38.58, gets divided by the share price, and that gets you more shares, which shows your accumulation right here from 12,327 up to 12,416. Almost about 90 shares, 89 shares right there that you gained by reinvesting this distribution. So then the next month, again, you got a 31 cent distribution, but now you're getting that on 12,416, that extra 89 shares. So your distribution goes up slightly to 38.86. And that trend continues down. As you can see, this distribution grows, and we come down here toward the end. Now we're up at the 5,000, mid 5,000 range for the last 3 months, $5,500. All of that has been reinvested. You have not taken any of that. You're accumulating more shares. And what that's done is you have added 2,481 shares to your portfolio. And that means your balance over here in column I has gone from the 525,000 where we started. And now you can see, because the share price is up, you've gained 2,400 shares. Your portfolio balance value is at $854,000, a $329,000 gain in 2 years. That's a 62% growth, or 31% per year. That is pretty fantastic. 2 years, I'd be happy with that. Now, you have not taken any of this. But what a lot of people like doing is prior to needing this, maybe they do this for a year or two. We'll just say you did it for 2 years. Now, instead of getting $3,800 a month, you have been preparing for needing it, say retirement. Now you get $5,500 a month and your portfolio balance is much higher. That's one way you can do it. Now let's look at the 50% drip. For those who are new, what this column represents is half of the distribution. Whatever amount you see here, you get it 2 times. The first time, we're reinvesting that amount to buy more shares, which you see here in this 50% drip column. But you also get this amount for cash, your income. Let's say we're doing a 50% drip. We start off, we say we're going to invest in this. We're going to take half the amount and buy more shares, and we're going to get this $2,000 of income to live on, or to supplement our income. Maybe we have Social Security, a pension, and so we're adding this to our income. You can see we're still gaining the amount that we're making. It goes up here to where we end at $2,500. Now, again, remember that's doubled, so this is actually getting a $5,000 payment, $2,500 of it, which we see right here, you're buying more shares, and $2,500 of it you're getting as cash. On this column, all over this 2 years, you've received $57,000 in cash. That's about $27,000 a year that you've received. That's a nice little supplement to your income. And you've added 1,186 shares by reinvesting half of it, and that means your portfolio has grown to $779,000, a 48% growth. Now that's the 50% drip. Let's see, because some funds, if you do a 0 drip, you actually watch your portfolio value go down, even though you're taking a nice, healthy income. With this, you can see that this is the full amount, where over here, it's only half the amount. It's showing you half. It's the same exact amount. If you take this 1929, multiply it by 2, it would come out to this 3858. This is showing the full distribution because you're taking it all as cash. Your shares stay at this 12,327 forever. That's how many shares you have. You're not buying more. You're just taking the distribution and spending it. Because the distribution has gone up, you can see you still get a slight increase in distribution paydays. Here we started at $3,800 and now we're ending at $4,600. Over 2 years, you're getting about an $800 a month raise in this fund as of this point. It doesn't mean it won't go down. That's a nice little increase, $110,000 that you've received, so $55,000 a year of income. But what happened to the portfolio? The balance, at one point, it did drop a little bit below, right there at the tariffs when the price went down. And you wouldn't panic over that. I would hope that you're down $8,000 from when you began. And it recovered very quickly. And as you can see, you end this time frame at $711,000. Not only did you get $110,000 in cash income, you increased your portfolio value, your unrealized gains, by $186,000. How is this fund done with total returns? Because that's really what matters. Income's great, but if you're losing value and your income is less than the value drop, you're losing money. So it's really not a great scheme in that plan. With this total return, full drip, you got $329,000 in unrealized gains for 62% growth. Because whatever's here, that's all you have, the value of your portfolio. Now, if you sold out of it, that would be realized gain, and that would be cash that you could take. That's a nice little growth. Or you can just let it ride and then go to a 50% or 0 drip, whatever you wanted to do. Now, with the 50% drip, you gain $254,000 in your portfolio unrealized gains, and you got $57,000 in cash. That's a $312,000 gain, or 59% gain, total return. Those are nice returns, 62 and 59% in 2 years. Now, the 0 drip, your portfolio still grew by $186,000, and you got this $110,000 in cash. That's a $295,000 gain for a 56% return. All 3 of these have done fantastic. Whether you take full income or partial income, your portfolio, your total return has been Excellent. Those are your 3 drips, but we have other options for you here. And this is where this sheet comes in handy. If you want to play around with this and you get a copy of it, you can do that. This first calculator, we can put the percent we want to drip, and then it calculates that. So on this, we just put a 30% drip, saying, okay, we're going to keep 30% and reinvest it, and we're going to keep 70% as income. With that model, and again, you can use any percent you want. With that model, you're getting about $1,300. Well, it starts at $1,100 and ends at $1,400 a month. You're getting about $33,000 over 2 years. And that might be saying, okay, I have income. I have other sources of income. I only need to supplement my income by $1,000, $1,100 a month. What would I need to do? And how would my portfolio have performed? And as you can see, you'd been getting pay raises and your portfolio grew. That's one thing you can do with that. You can put, if you want to put 20%, you can do that and see what happens. And so it just shows you the different numbers you can put there. We can keep that at 30%, and we can put this at, let's say, 50,000, and everything changes. So at 50,000, you're getting $257 a month, but your portfolio has grown to 71,000. You can play with these numbers and see what you want to look at depending on what you have personally. We're sticking with this 525 because that's what our series does. So I want you to be able to look at this video, and maybe you look at JPIX or you look at QQQI, and you're seeing the same numbers, because some people don't have these sheets and they haven't bought them, and that's fine. This way you can look at one video versus another and see which fund has performed better, and you're seeing the same numbers. Just makes it easier. That's why we stick with this number. Now, this last calculator, this one here, you just put the amount you want to keep. This is a percentage, but say you're like, I need $3,000 a month, and I'm going to put everything else back into the drip. With that, it's static. There's no pay raise. It's $3,000 a month along the way. And this shows you on this column S how much is being reinvested. Over the course of this 2 years, you're getting $3,000 month in, month out, every month. You've added 700, almost 800 shares, and you've increased your portfolio by $232,000. Again, maybe you don't need that. Maybe you need 2,500. Do that in your portfolio. So everything's dynamic there. You can change the amount that you're keeping and see what that does for you. Maybe you're like, okay, I need $6,000 a month. Let's see what happens. We're just going to play around with this. You can see it, your negative drip. That means you're having to sell some shares. You see your share count dropping because you're taking the income and selling some shares. So you get into the negative a little bit. You get a little bit of red here, but still over the course of this 2 years, you've sold almost 900 shares, but you've gotten $162,000 out of this from income, and still grew your portfolio by $134,000. This is just something you can play with and see how you like GPIX. Do you own GPIX? What are your thoughts on it? Let's get some dialogue going in the community. Let's share pros, cons of GPIX. What's your favorite fund? And all that good stuff. I appreciate you joining me on Simply Money, and we'll see you next time.